Why you shouldn't claim Social Security early, or should you? How not filing a tax return could land you in jail. And what would you do if you found $500 in an ATM? This is Your Money, Your Wealth. Today on Your Money, Your Wealth, Joe and Big Al discuss the pros and cons of taking Social Security before full retirement age, tax mistakes that could cost you huge penalties or worse, IRA myths, the morality of found money, and what they know and love about social media. The fellas also answer emails from the absurd to the sublime, from making 40% annual returns on your investments to sound strategies for putting inherited IRA money into a Roth. Now, here are CFP Joe Anderson 2323 on Instagram and CPA Alan.Clopine on Facebook.
Alan, I have this ongoing question that I'd like to get your input.
Okay.
We did our, Social Security webinar.
Right, last week, huh?
Yeah. And
a lot of people came to that.
Yeah, 500.
Yeah.
So here was the break it down. Couple of key questions that were asked.
Okay.
Should I take it at 62? Because I'm retired, it's hard for me not to take this money.
I know, it's right there.
It's right there.
Like, why shouldn't I take it?
God, I just So it's like, all right, well, let's just go through the math here.
Sure.
So if you take it at 62, and let's just assume that your full retirement age is 66, just to keep things simple.
Okay.
If you take it at 62, you would receive a 25% permanent haircut on the money.
So that means if you would have got $2,000 per month at 66, you get $1,500 at 62.
$1,500, so $500 less. But it's 4 years earlier.
Right, so you get all that money, every single month, right?
And if you take it at 70... well, then, from 62 to 70, it's like a 73% increase on your benefit.
Right.
Right?
Yeah.
Because you get this delayed retirement credit, they call it. It's 8% per year after you turn full retirement age.
Right.
And so it's like, well, Joe, I'm retired. I'm turning 62. I want to take the money.
Right.
Even though I understand that I'm going to receive a 25% permanent haircut, but it's right there.
Yeah.
I can invest it.
Because it's like a bird in the hand. It's a sure thing, right?
And that's why. You see the numbers, Alan.
Oh, yeah.
What, 65, 70%?
Most, yeah. In fact, when you look at the numbers of the people that actually take it later than full retirement age, which this year is 66 years and 2 months, it's like 2%, 2 or 3%,
right,
if that.
So it's like, all right, I'm either taking it at 62 full retirement age. There's no way I'm going to wait.
Yeah, I'm not going to go past that. And some people do wait till their full retirement age, because if they take it earlier and they're still working, they have to give some of the benefits back.
Yeah, but they don't actually give it back. It's just recalculated. And how it works.
Yeah, it's true. It's worth explaining because people don't really understand that.
So there's an earnings cap. So if you do take it at 62, there's an earnings cap on it. In 2017, I'm going to round here just to make my math easy. And you got a pen right there, don't you, Al?
Yeah.
It's 16,900 and something?
920.
Yeah, 16,920.
Pretty good rounding.
So let's just call it $16,000.
Okay.
All right. So let's say you take it at age 62 and you go to work and you make $40,000 a year.
Okay.
Okay. So then you take $40,000 and you minus 16,920, but let's just do 16,000.
Okay, so that leaves 24,000.
All right, $24,000. And then you divide that by 2 is 12. So then that's your reduction of benefit.
So they take 12 back.
They take $1 for every 2.
You give 12 back and you get to keep 3.
Yeah, you get to keep 3. And so if I do that math right, so $1,500 a month is your benefit. So if you get 3, so they're going to take 10 months of benefit back from you. So let's say you do that the next year. So the same thing's going to happen. They're going to take 10 months of benefit. So that's 20 months of benefit. So they calculate Social Security benefits on a monthly basis.
Right.
So they'll just assume that you didn't take it at 62, that you took it at 63 and 8, 9, 10 months, or right?
So in other words, by the time you get to full retirement age, they're not gonna ding you for the money you had to give back. So in other words, your benefit will be higher.
They'll just increase your benefit like you never took it.
And I think that's worth, because a lot of people just assume that, boy, once I give it back, it's lost forever. But at least the Social Security Administration is a little bit fairer than that.
So it's like, but let's say if they made $60,000 well, that would probably wipe out their entire Social Security benefit.
You give it all back, and it's as if you never claimed it.
It's like you never claimed it.
For purposes of future benefit.
You got it.
Got it.
So even though I did claim it at 62, I'm getting that 25% permanent haircut. But if I'm still working, right, it's like, okay, well, no, you got to give it back.
Right.
And so you have to tell the Social Security Administration as well that you are working, that you plan on working. Because here's what happens if you don't. So let's say you get that $1,500 a month benefit. All right. And so you enjoy that benefit. You're not. And then the next year happens, you file your tax return. The Social Security Administration looks at the income. And people are saying, well, why do they do that? Well, because they have to look at your income to determine what your benefit is, because it's all based on how much money that you make and how much money that you put into the system. So then they'll look and say, Clopine, what are you doing? You made $40,000. You claimed it at 62. We should have only gave you $3,000.
Right.
So they'll withhold your Social Security benefit the next year until they make it up.
Until it catches up.
Until it catches up.
Got it. I see. Okay. Well, I suppose that's fair.
Sure.
Yeah.
But it confuses people.
It does confuse people. And, of course, they always know because Social Security Administration talks to the IRS and vice versa. So they know exactly what you're making as far as earned income goes. So they can do the calculation after the fact, and then they'll just ding you against your future benefits.
Sure. They'll just, they'll just withhold it.
Yeah, right.
Like a big fat tax.
Until you're caught up, just like you said.
So I guess back to the argument of, do you take it at 62? Well, if you're still working, you have to do this calculation,
right,
to see if it makes sense. Because some people want to claim it at 62 because maybe you have an older spouse that wants to claim the spousal benefit. Well, you cannot claim a spousal benefit unless your spouse is collecting a benefit.
Right.
So one spouse is older, and that older spouse has a lower benefit. The higher benefit would be the spousal. And again, the spousal benefit is based on 50% of full retirement age. So if the other spouse claimed early, it's still based on that 50% range as long as the spouse is full retirement age.
Right.
How confusing is this crap?
That's crazy. I have to diagram it out myself. It's so complicated.
To say the least. But now, do I take it at 62? Well, if I'm not working, then it's like, well, it's right there.
Right.
Take it and invest it. All right. Well, that might work.
It
depending
might.
on what you're going to use as assumptions.
Right.
That's the big thing, because whatever assumption that you use is going to determine if it's going to make sense for you or not.
Right.
If you don't need the money, if you want to take it and invest it, well, if you think you can get, I don't know, a 10% rate of return, well, yes, that will pencil out.
Yes, it will.
Right?
Agreed.
And if you die prematurely, prior to life expectancy at age 85, yes, those numbers will pencil out all day long. So I guess you have to do a little bit of calculation. But I truly understand that it's like, man, it's right there. I don't know what's going to happen.
Yes.
We got a lot of baby boomers that are, collecting. 65 million people are already taking benefits. You got 10,000, right, a day turning 65 for the next several years, 15, 14 years, something like that.
Right.
So I get the urge. I
Yeah.
get the urge to take it. But I would encourage you to not necessarily look at it as an investment. And again, this is your money. We're just kind of, just a couple of kids having a conversation about some really boring stuff.
True.
But I'm kind of more in favor now of not necessarily saying, no, wait, run some numbers. And if you feel better, if it makes you happy, life is short.
Wow, we're coming full circle. Take Social Security early and pay up your mortgage.
What the hell?
If it makes you happy, go for it.
I mean, if it makes you sleep better at night, I think that's what you do.
Because you got the money coming in. The flip side of that, of course, is if you're just going to spend the money anyway and not save it, and you got other resources, why not wait? And then you've got great longevity insurance, right? But you take it at 70, you've got a lot more income for life. Now, there is a possibility, Joe, that there could be means testing down the road. And if you have a lot of assets and a lot of income, well, maybe this makes a lot of sense. Take it now while you can.
Sure.
On the other hand, means testing has been proposed for decades and it hasn't happened. So maybe it won't happen. So it's awful hard to say.
Then, because there's so many different factors involved, you can't necessarily look at this in a bubble of saying, all right, well, I'm 62, here's my benefit, let me take it. Well, you have to look at what other assets do you have? What other type of fixed income sources? Are you married? Are you single? What is your tax bracket? because the taxation of Social Security needs to come into play.
Right.
Because if you live in the
That's true,
state of
too.
California, right, the state of California doesn't recognize it as income, so it's tax-free to you from the state of California.
Yep.
Plus, at the most, you're going to get a 15% tax-free bump on the Fed side because
At worst case.
At
In some
worst case.
cases, less of it than that is taxable.
the numbers for provisional income, right? So to determine how much of your Social Security benefit is going to be taxed was based on law from the 80s, 1983, Ronald Reagan. And so back then, right, so everyone was up in arms of saying, oh my gosh, you're going to tax Social Security, because that was the first time Social Security ever became taxable, was back in the early 80s. And so if you look at those numbers of provisional income, it was only going to affect the top 1%ers, so those nasty 1%ers,
Yeah, they're
right?
terrible people.
Those terrible people, right? Look, then everyone was like, yeah, no big deal, right? They can pay it. But now, if you look at them, they never inflated those numbers with inflation, and they don't have any plans to. So most people that listen to this program will pay taxes on their Social Security benefit.
Yes.
So when you hear other things of, well, it's only going to affect this, like the AMT tax, for instance. I mean,
Right.
we could go on and on. So anyway.
Social Security is likely to be an important part of your retirement, and as you just heard, it gets complicated. Watch our free Social Security webinar in the Learning Center at yourmoneyyourwealth.com to learn how to maximize your Social Security benefits under the new rules. Joe will teach you about claiming strategies, how to calculate your benefits, what benefits are available, and how they're taxed. To view the free Social Security webinar, visit the webinars section of the Learning Center at yourmoneyyourwealth.com.
I found this kind of interesting, Joe. This is a recent survey. This is University of Maryland's program for public consultants. And what they came up with was they asked 1,800 registered voters about in Maryland about their opinions on income taxes. And to sort of put this in context, as a reminder, in September, at that point, candidate Trump, who became President Trump, promised to enact changes in the tax code by cutting personal taxes, cutting corporate taxes, cutting taxes on capital gains and dividends, eliminate estate taxes, and he talked about providing tax relief to small businesses, which are sole proprietorships, partnerships, S-corps, and the like. So that's what was proposed. And then they asked 1,800 people, what do you think? What do you think of all this? Because, Joe, when you and I talk to people, almost everyone uniformly says you got to reduce taxes. But I found this survey interesting. In general, the majority agreed to raise taxes, of course, caveat, for the wealthy, right? And capital gains and dividends, as well as higher rates for corporations. And the reason why they did was they were more concerned about having a balanced budget than lower taxes, which I found rather interesting. 52% of respondents are willing to raise taxes 10% for those making $1 million or more. Now, that's an easy thing to vote for if you're making less than $1 million, right?
Sure, right. I mean, how many people make $1 million a year?
Yeah, not that many. So capital gains, the GOP plan, not the Trump plan, the GOP plan wanted a maximum rate of 16.5%. Only 15% of those surveyed endorsed this idea. 85% thought it was a bad idea to reduce those capital gain taxes. And
Well, I guess most individuals as well have most of their assets in retirement accounts,
Right.
Liquid assets. They
Yes.
either have real estate, their primary residence, maybe a second home, and then they have a giant retirement account.
Right. Now, in terms of corporate rates, right now the highest corporate rate is 35%. But that's not if you take the total effective rate of all corporations in the country, Joe, it's 19.2%. In other words, that's the average tax rate that C corporations are paying tax on.
C corporations?
Mm-hmm. Yep, C corporations.
Well, because if that's the average of all businesses?
Yeah, of all C corps, yeah.
Well, I would say 80% of businesses are small businesses.
That's true. That's true.
And maybe 30% of those are not profitable.
Well,
They're not making any money.
that's true too.
That's
true too.
you take a look at the majority of that. I mean, they're not talking about Google.
No, they're definitely not talking about Google.
Or Microsoft
But,
or GM.
So anyway, 53% of the survey respondents wanted to raise the effective rate to over 20%.
Yeah, well, I mean, that makes sense when you look at it like that. You can't.
Yeah,
That's so misleading.
it can be.
Oh, it can be. What are you talking about? It is totally misleading.
Anyway, you know why I found this interesting, though, Joe, was because, like I said, when you and I talk to almost anybody, they all want lower taxes. But when you think of it in the context of do we want to balance our budget? Do we want to stop creating all this debt that is only going to compound our problem for future generations? I think a lot of people are pretty sensible about that, which I personally applaud. I think we've got to get our budget balanced before we can do much of anything, because we're really basically saddling our financial woes on future generations. So that's my 2 cents.
Wow. Big Al is getting running for office here soon.
Not really.
Well, I mean,
not really.
yes, I agree. I would like a society where there's
We actually have
law enforcement and
Yes.
not anarchy,
Right.
and everything else, and nice roads and good schools,
Right.
And
And what's always interesting to me is the campaign promises, which I mean, you just think about it in your head, and that no one can deliver on what they promise. I mean, they promise lowering taxes. They promise, in the case of Trump and many, let's increase the military, let's increase the infrastructure, but let's lower taxes and let's balance the budget. And I mean,
it's not an easy gig.
You don't have to be an accountant to figure out that doesn't quite add up, right? I like the thinking. Don't get me wrong. I like the thinking. I like the idea. I think we should work towards that. But there has to be some compromises here.
Well, I don't know. The market right now is fairly, I guess good is irrelevant now. I mean, it depends on who you talk to.
True.
So, all right. That was Political Talk with Big Al.
Time now for Big Al's List. Every week, Big Al Clopine scours the media to find the best tips, do's and don'ts, mistakes, myths, and advice to improve your overall financial picture in handy bullet point format. This week, 10 tax mistakes to avoid.
A lot of people make mistakes, particularly when they try to prepare the returns on their own, particularly when they do them by hand.
Yes.
And we've seen that over and over again. And I guess if you do your return by hand, I'm not saying not to do it, although I'd say be careful, because tax law is pretty complicated, and it probably behooves you to use a computer program like TurboTax or hire a professional. But a lot of people still want to do it by hand.
But I think most people that do it by hand, it's like a 1040 easy.
Yeah, it's simple.
But if you had like 8 rentals,
yes,
and,
much
pass
harder.
through
But
S Corp,
I have
1120S done by hand.
I don't think I've seen a corporate return done by hand, but I've seen many individual returns done by hand that shouldn't have been, because they own rentals and there's passive loss rules, and they completely ignored that, and they ignored alternative minimum tax because they didn't really understand that, and all kinds of other things. But anyway, number one mistake, particularly if you're doing it by hand, is transposing numbers. Right, so you put in an amount. You put 6,900 and you put 9,600, or whatever the transposition is, and be aware that the IRS knows a lot of the numbers already. So they're kind of just checking what you put down. For example, they know your wages, they know your interest income, your dividend income, they know the proceeds on your capital gains. Now they even know the basis, what you paid for the capital gains. They know what you sold a property for. They know you have a partnership. They know what you earned from the partnership.
I'm surprised when you look at the numbers of audit, it's fairly low.
It is low.
I'm guessing you're not seeing a guy with some glasses, sitting in a dark room checking returns and checking W-2 statements.
No,
it's all computer driven,
right?
And you would think that
there'd be lots and lots.
It would
of audits.
be 50% of people would get audited,
right? Because there's some kind of mistake somewhere.
Somewhere.
Right.
I mean, you just match it, red flag it, send out a letter.
Right.
So.
Because, we learned last week that the number of audits, the average audits is like about 1 in 120 people get audited, something like that, which means less than 1% are actually getting audited. And most of the audits these days are done by letter. They're just, you get a letter in the mail. Hey, we got this. Right. You said that. You need to pay us this much extra tax unless you disagree. If you disagree, tell us why.
Right. And I mean, it's real simple, too, because I get a couple of other W-2s from the schools that I teach at.
Yeah.
It's not a lot, a couple $100.
Right.
And sometimes I forget to give it to
your tax guy.
Yeah.
Yeah.
And so then I get a letter, and it's like, hey, you owe us another $16. And I was like, all right, whatever.
You pay it. Right.
Yeah.
Yeah.
Yeah, right? So, I mean, that's why I was thinking, I was like, oh, man, I totally forgot about it. But it was only a few $100s, how the computer can catch that. That's why I was thinking, why wouldn't there be more audits?
Right.
Anyway.
Here's another mistake is not filing.
You just don't file it.
Just forget it. I don't agree with taxes.
I'm not going to do it.
Unconstitutional.
That is called tax evasion.
The IRS doesn't like that. Our government doesn't like that. But in some cases, people don't really have to file because their income's low enough. And right now, surprisingly, if you're single and your total income is less than $10,350, you don't have to even file a tax return.
All right. How about if all of my income is, let's say, Social Security, and I have a house,
okay,
and I die, and my heirs sell the house, right? Maybe it's a modest house, couple $100,000, right? But then I get the 121 exclusion, so there wouldn't be any tax, on that primary residence. Plus, it's a step-up in basis anyway.
Yep, true.
Right. So Social Security is not taxed because there's no other income.
Yeah.
And then my house is sold. Would the successor need to file a tax return?
Yes, and the reason is because.
So you're saying I should have filed that tax return for my grandmother?
Yeah, they're coming after you.
Oopsies.
Well, because in other words, if you sell an asset and the proceeds are greater than $10,350, you have to file a return to show the tax basis. Right? You might get a letter on that. Anyway,
that was years ago.
Well, you got maybe because they can audit you 3 years after you file, as long as you file timely, right?
Yeah, well, there's no tax anyway, so I'll just give the stuff to you. You just
that's right.
Bust out a return.
That's right. You didn't file. You didn't file timely.
No, I didn't even file the return.
Yeah, right. Okay. Well, here's the number for married. 20.
So what are you saying? I'm
going to visit you in jail, and I'm going to. What kind of? I'll bake you some bread.
Oh, wow.
Like pumpkin bread or banana bread. The number for married is $20,700. But here's another mistake: is people are under those amounts and they worked some part-time jobs. They had withholding. You're not going to get your withholding back unless you file. You don't have to file because your income is low enough, but you should file so you can get a refund on your tax withholding. How about number 3? Fear of filing. So some people figure out how much they owe the IRS and decide not to file the return because they don't have the money to pay it. That's not a good idea.
No, because that's just going to...
Not a good idea.
Compound the problem. Because
here's what happens is if you file and don't pay, well, then you want to get set up on a payment plan, and there's different ways to do that. But if you don't file at all, because you think, well, then they'll never know, well, by the time that they get around to catching you, they actually charge you a non-filing penalty of 5% per month in addition to the tax, in addition to late payment penalties, in addition to interest. Oh, man, that's the last thing you ever want to do. Plus, I'll tell you what, not filing is a criminal offense. And actually, some people go to jail every single year for not filing. So don't be one of those people.
Well, this is just a really wonderful show. Oh, God.
I'm trying to keep people out of trouble.
Look at Big Al.
The fourth item is doing putting your wrong bank information, your routing number's wrong, and so the refund gets who knows where it goes. It doesn't come to your bank account. That apparently happens all the time. People forget to check their bank account number and their routing numbers, and so the IRS can't.
All right, so let's say it sends it to a different bank account.
Right.
So you're waiting for it, don't get it. You call the IRS. And they'll say, no, we sent it to this routing number.
Yeah.
And you're like, oh, no, I'm sorry. I changed banks. Here's the right routing number. Are they going to send me more cash or do I?
I doubt it. I think you'd have to settle that with the bank, probably. The bank got put into the wrong account. I don't know, not really sure. I don't think that they're in the business of sending out a refund twice. Number 5, Joe, is people put incorrect names. That's ridiculous, right? But it happens. Like people get married and they put their new married name, but Social Security Administration has it down as the old name. The return gets kicked out. There's a problem. Or here's the example. His friends know him as Machine Gun Kelly, but the IRS knows him as George Barnes. So don't put Machine Gun Kelly.
That is so stupid.
Here's the next one. Extension confusion, which you can extend your tax return. In fact, the tax due date this year, Joe, is April 18th. It's not April 15th. It's April 18th is the last date you can file on time. But you're allowed to extend your return for 6 months by simply filing an extension. And the IRS gives you 6-month extension, no questions asked. But make no mistake, that does not extend your period to pay. In other words, if you owe or you think you owe, you have to pay that with the extension. If you don't pay it with the extension, then you get charged late payment penalty as well as interest penalties. So be aware of that.
You know, we had a discussion with a hypothetical client that receives a K-1, right, at the end of the year. And so it's like, all right, well, do I pay quarterlies on this, or do I just kind of, because, you know, a lot of small businesses, you don't really know what those profits are going to be until, you know, you close the books.
True.
So what's your advice there? What happens if you don't pay quarterlies and you have a large K-1? I mean, what's the worst that can happen?
Well, if you don't pay quarterlies, like let's just say you should have paid $3,000 per quarter. So the quarters is April 15th, June 15th, September 15th, and January 15th. So what they do is
Didn't they change those dates to kind of some weird stuff recently?
No, that's been that way for a while. But the weird thing is it's not April 15th and July 15th. It's April 15th and June 15th so that the government would get it before June 30th fiscal year end. I think that's why. That was a while ago.
Okay.
California changed their dates.
Yeah, that's
so that they could get money quicker, and they changed the amounts that have to be paid.
Right.
Yeah.
It's not an even split of 4.
But like, let's say you should have paid $3,000 per quarter. So that first payment was April 15th, and if you pay it the following April 15th with your tax return, you'll get charged 3% interest on that $3,000, you know, for a year, right? So that's, what is that, $90 interest on that payment. The second payment should have been paid June 15th, so you'd get charged 3% for 10 months, right? So I don't know what that is, but call it $80, something like that. And then the next payment, you should have paid that September 15th, so you get charged whatever, $50 for that payment. And the last payment, you should have paid January 15th. You're 3 months late. You probably get charged about $20 interest on that. So that's how that works. Now, if you don't pay the payment with your tax return or extension, not only does that 3% continue, but then they charge you 0.5% per month for late payment, right, which equates to 6% interest. So now you're basically past April 15th, you are paying a 9% interest rate. And if you don't file an extension and don't file, now you're late filing. Now it's the 3% per year and 5% per month, although that does cap at 25%. So you don't want to not file.
So what did we learn?
To summarize, we learned to not transpose numbers. Make sure you file, even if you have fear of filing.
Yeah.
Get the right.
A ton of people have that. I mean, we've had people come into our office with a box, you know, almost in tears of saying, you know, I haven't filed a tax return in 4 years.
Right.
You know, oh, God, I mean, what do I do, you know?
Should I move to Mexico?
God, I don't know. Should I file all 4 at once? Are they going to come after? I mean,
yeah,
it's okay.
If you need a free financial assessment, if you missed an episode of the podcast, or if you're just dying to see what Joe and Big Al look like, visit yourmoneyyourwealth.com. Access the Learning Center with resources, white papers, and webinars on investing and financial planning. Subscribe to the podcast and see clips of the Your Money, Your Wealth TV show, all at yourmoneyyourwealth.com.
If you didn't hear last week, Big Al said we've been on now for 10 years.
10 years together. You've been on longer than I have.
Well, yeah, I'm the lucky one.
I think you preceded me by about
6 months.
Yeah, I was going to say 3, but maybe it's 6.
Oh, maybe it's whatever. I was totally guessing. I had no idea. Yeah, I was a wily veteran.
Yeah, I know. By the time I came on, you had to show me the ropes.
Yeah.
You said, Al, you got to talk into the microphone.
Yeah, that was about it. That's all I still know.
Because the rest of it is just talking.
Yes.
How hard can that be?
Not too much.
Yeah. It's not that hard.
All right. I got a question for you.
Yeah.
Let's say you go to the ATM machine.
Okay.
All right. And you're going to take some cash out.
So you're presuming I got money in my bank account?
You have a big wallet. We all know this.
Think I got money there? Okay.
Yeah, guaranteed.
Okay.
And so you go, you're going to put your card in, and all of a sudden you look down, and there's $500 in the machine.
Okay.
What do you do?
Well, I suppose.
And you're not at a bank branch.
It's just like.
You're at not a 7, just like outside somewhere, in a mall.
Like at the airport. Like there's I use Bank of America, so there's ATM, B of A ATMs at the airport.
You're not at the bank branch. Anywhere you want to imagine. If you want to imagine yourself at the airport, that's all be it. You're going to Hawaii.
Because I'm going on a trip.
Yes, there you go.
That's what I want to
Just
imagine.
your little happy place.
Yeah.
What do you do?
Oh, that's a good question, because part of me wants to just take it because it's just free money sitting there. Another part of me wants to turn it in, but it'd be easier to turn in if I was at the bank. I'd say, this was here.
Where would you turn it into?
Well, if it were the bank, you'd take it to the bank.
All right, so then you go to the bank. Let's say you're at the bank. So you're saying you're going to take it if you're not at the bank. You're at the airport. You got the $500.
If I just got out of church, I would probably go to the bank teller and say, "This isn't mine. It was." But any other day, probably I might be tempted to keep it.
Right. That's so.
Right.
So let's say you go to the bank and you're like, all right, well here, this $500.
Right.
Would you wait won't you just wait at the ATM machine? Just in case the person comes back that forgot to grab the cash?
Well, yeah. I mean, I would.
How long would you wait?
I don't know. This is a moral question.
Yes, I'm sorry.
I would.
Because it happened to a friend of mine.
I guess I would probably pick it up and hold it in one hand while I did my transaction. So I am waiting because I'm doing my transaction.
Got it. Yeah, that's a tough one. I don't know. What would you guys do out there? It's if I was at the bank, right? I would just say, hey, you're outside.
That to me is an easier thing. If you're at the bank, it's clearly not yours, and
Sure.
it wouldn't feel right to keep it. But like if it's somewhere else, like sometimes there's these kiosks in a shopping center, like nowhere near a bank. It's like, well, that seems like you found it on the ground.
Yeah, but it's kind of. You just like brush your arm against it a little bit.
Have it fall out of the container.
And then you just do your oh, look at this. What's on the ground? Yeah. I got you.
I mean,
cool,
if a $100 bill's on the ground, you wouldn't. I mean, you'd pick it up and keep it, right?
Yes, I would.
Yeah,
I would.
But if it's 3 feet up in the air in a
I
container,
guess, yes. Now that's the moral dilemma.
Right?
Yeah. Oh, well, it happened to a friend, and what she did is that she called the bank,
right? The ATM,
because it wasn't at an actual branch,
so she couldn't like walk in.
Right,
and say,
exactly.
Hey, this
So
was here.
she's like, "Hey, you know what? Did anyone?" Call or something.
Right.
I found this money.
Right.
And then they're like, well, you could give it to us. And she's like, well, what are you going to do with it? Well, no, we would just hold it just in case if someone claims it.
And then she could come in after if no one claimed it?
No.
No. They keep it.
Yeah, the bank keeps it. And she's like, well.
Oh, that's weird.
Yeah, so it's sitting in her
that doesn't
underwear
sound right.
drawer.
Yeah.
She's waiting.
Waiting for someone to call.
I guess. If something bad happens,
For
she'll
the
probably
feds to show up. We're aware that you took $500 out of an ATM.
I think, it was. I'm not sure it was $500. I think it was maybe a couple $100, but still.
Right. That is.
Yeah,
a
she
tough
doesn't.
one.
She doesn't. She can't spend it.
Right.
So it just sits in her.
Because it's not really hers.
Yeah. Right. So,
know what?
and I'm like, I would never want that to happen to me.
I know. Well, maybe if you kept it, maybe you do this. Maybe you keep it for a couple months and then no one calls and then you give it to charity. How about that? Then your conscience is good.
Yeah. There you go. All right.
So what would you do if you found money in an ATM? Get social with Your Money, Your Wealth and let us know. Follow us on Twitter at YMYW Show. To connect with us on Facebook, LinkedIn, YouTube, and Google+, just search for Pure Financial Advisors.
Hey, you're a big social media guy, aren't you?
Yeah, I'm on Facebook. You bet. That's it, though.
That's it?
Well, I'm on LinkedIn, too.
I'm not really into any of that. But
You're more into LinkedIn than I am, but I do enjoy Facebook, and I'll tell you why. It's because I originally got into it to kind of follow my kids, and then I got to where I kind of liked it. I got to follow some of my friends and what they're doing.
I'm on Instagram.
Okay, I'm not on that.
Well, Joe Anderson 2323.
Yeah?
Yeah, you can follow me.
Okay.
Al.
All right, good.
I'm like, I don't even know. I mean,
Are you on Snapchat?
No.
Okay.
No Snapchat.
Okay.
No, no.
Twitter?
No. Yes, we are on Twitter.
Pure Financial?
Pure Financial. Yeah,
You're not personally.
Oh, I'm tweeting all the time.
Do you tweet at 3 a.m?
I do.
Yeah.
I do.
Okay.
But no, this Instagram, I like it. I put some backstage pictures of you and I doing the TV show.
Okay.
And all sorts of kind of things that we do, kind of behind the scenes.
Okay, good. I'll have to get on Instagram to check it out.
Yeah. And getting some followers.
Yeah.
I'm like, who are they? I don't even know what following means. But I'm going to be an expert here soon, Al.
So what is it? Joe
Anderson 2323.
2323. Okay.
Yeah. Michael Jordan.
Okay, got it. I see.
Yes. That's why the 23. Michael
Okay,
Jordan.
I'm with you.
Yeah. What do you got?
I got 6 myths about IRAs you can't afford to believe.
IRAs, there's a lot of funny rules when it comes to individual retirement accounts, so you want to make sure that you understand them.
Yeah, you're not kidding, Joe. And the first myth that is definitely not true is the IRS. People think that the IRS does not let you contribute to a 401k and a Roth IRA or a regular IRA in the same year. In other words, those are different. You can contribute to your 401k and your IRA, or your 401k and your Roth IRA in the same year.
Absolutely. That's missed all the time. And there's probably the spousal thing on there too.
Yeah, that's one of them. Yeah, you want to go to that next?
Well, no, I mean, it's kind of one of this, like, let's say if you're married and you have one spouse that's working, maybe one spouse that's not working, a stay-at-home parent, maybe already currently retired or whatever. As long as one spouse has earned income, the other spouse can still contribute to a retirement account.
Right.
So, so if you have excess cash flow, if you have money sitting in, a brokerage account or savings account or things like that, it makes a ton of sense for you to max out those Roths.
Yeah, it really does.
$5,500. I would much rather have it in a Roth than sitting in a brokerage account.
Well, that's right, Joe. And there are income limitations. If you're married and you make more than $196,000, you cannot do a Roth contribution.
But it's $194 still for 2016. So
True.
If you still have not made that Roth IRA contribution or IRA contribution, you have a couple of weeks. Get it done, especially if you don't have a Roth IRA, because there's this 5-year clock when it comes to Roth IRAs.
Right.
So how the 5-year clock works, and I'll just talk about contributions, not the conversion one, is that if I make a contribution to a Roth IRA, there's a 5-year kind of waiting period where I cannot take any of the growth out of that Roth IRA for 5 years or 59 and a half, whichever's longer. So Al and I see a lot of people that are in their 60s that have never established a Roth IRA before. So they contribute to Roths for a couple of years until, maybe they retire at 65. So they get 5 years of contributions. So they're all good. But how about if they want to retire at 62? Well, they can't touch any of the growth of those dollars until age 65 if they started it at age 60.
Right.
So if I make a contribution before April 15th, my 5-year clock would start January 1st of 2016.
Correct.
So absolutely, just put a few $100s into it. That opens the 5-year clock. Highly encourage you to do that before it's too late.
Yeah, and that's one of the other myths is that you cannot contribute to the 2016 tax year because it's already passed. Not true. You can contribute all the way to April 15th, and this year it's actually April 18th because that's the tax filing day. Joe, another one is that I make too much money to contribute to an IRA, and there's different limitations here, but anybody can contribute to an IRA that has earned income as long as they're younger than 70 and a half. End of story, period. Right? Now, you may not be able to deduct it, but you can contribute. And in some cases, even if you can't deduct it because you're in a company retirement plan and your income's too high, you may still want to do a non-deductible regular IRA because then you could do what's called a backdoor Roth. And of course, this is only if your income is in excess of the Roth contribution income limitations. But if it is, you can do a non-deductible IRA and turn right around and convert it to a Roth, and there's no tax to pay on the conversion because you got no tax benefit putting putting the money into the IRA. I mean, there's some caveats. You can't have other IRAs, otherwise this gets more complicated. But you can have 401ks, 403bs to be able to do this. It's a great strategy.
It's time to dip into the email bag with financial questions courtesy of Advisor Insights from Investopedia and you, the Your Money, Your Wealth listeners. Joe and Big Al are always willing to answer your money questions. Email info@purefinancial.com, or you can send your questions directly to joe.anderson@purefinancial.com or ellen.clopine@purefinancial.com.
All right, ladies and gentlemen, this is a doozy here.
Oh, really? Okay.
This is a doozy.
Why do you say that? Is it a long question? You have a long thing to read?
I do. And I see some percentages here that this is going to be interesting. And I think this will be a good lesson to all of us to learn.
Okay.
All right. I need guidance on my investment strategy.
Okay.
I'm considering 2 strategies, and I need a professional to guide me through the pros and cons of each of them.
Okay. Got it.
My first strategy is do short-term investments by selling a stock as soon as I have a 3% gain on that stock, and then reinvest that money on another stock, assuming each stock goes up by 3% within a month.
Okay.
My return would be roughly 40% per year with the compound effects.
Okay, sure.
That's pretty easy to do.
Yeah, 3% per month. That's 36%. Compound interest, 40. I'll give you that.
All right. I understand that things don't always come out as planned, so my conservative target return is 20%.
Now let's go back. That was the first correct thing I heard in this whole statement. It's things don't always turn out like you predict.
Okay, so he's got 3 sentence out of 6.
Expecting 40. I'll take 20.
His conservative, 20. He wants 20.
Yeah.
My second strategy is to do long-term investments by buying stocks that have good dividend history.
Okay.
And hold it for the long term.
Okay.
I don't expect to use this money in my brokerage account to cover any monthly expenses, so either way will work as long as my money can grow. My investment goal is to maximize the take-home gains after tax.
Okay.
So what say you, Clopine?
Well, I'm not a fan of either one, but if I had to pick one of the two, I'd pick the second one, long-term stocks with dividend history, but I see major issues with both. So first of all, the first one, short-term investments. I own a stock. When it goes up 3% within a month, then I sell it, and then I buy the next one.
To get another 3%. So each month he's doing this.
Yeah. How do you do that? I mean, who does that?
40% returns.
Who can do that?
Come on.
I mean, probably the seminar gurus tell you can do it, but in reality, that's not practical or possible.
Why is that?
Because
it sounds easy enough.
Because the stock market that presumes the stock market goes up in a straight line at all times, and it doesn't. It's very volatile.
But when those stocks go down, other stocks go up, don't they?
Yeah, but so what if you have what if you buy your stock and it didn't make the 3% before the month? It goes down 8%.
How does he find the information of that particular company before it goes up that 3%?
Yeah, what information does he or she have that no one else has?
Right. Because if the company was going to go up by 3% for that month, something has to happen for that to have a 3% jump in a month.
Right, because if it's already expected to happen, well, the price would already reflect that.
Yes.
Right? So in other words, based upon all known news, right, then it's already priced in. That's how stocks work, because they're forward-looking in terms of price.
Yeah, they're already taking a look at 10 years out of what those cash flows of what those companies are anticipating to generate, and they take the present value of those future cash flows and they call it a price. In layman's terms, it's more complicated than that, but you get what I mean.
Now let's say even that you could do this, and let's say you made, I don't know, 40%. That seems very unrealistic. Even 20. Let's say you made 10, just to throw out a number, and they're all short-term gains. So they're all ordinary income taxes. If you're in the highest tax bracket, you're paying 50% tax between federal and state in California, right? So you're only keeping half of it. And one of the last sentences was, I want the the most
After-tax.
after-tax return, which is why the long-term investing is better because it's after tax. But if you're investing just in long-term stocks that have high-paying dividends, you're very segmented in what you're owning, and you're taking a lot more risk than you know. And furthermore, in low interest rate environments like we have right now, you and everyone else is looking for high dividend paying stocks. So do you think the price of those stocks is actually pretty high because they're in demand? The answer is yes. So you're buying something high, which may not be the best strategy.
But you hear stuff all the time. It's like, all right, well, if the stocks go up, and you know what? I'm not going to get greedy. I'm only going to take 3% profit per month.
Yeah, what's so hard about that?
That's so. I mean, that's the lack of information and education when it comes to people investing.
Well, and here's the thing about that is, let's just say this individual does that for 3 or 4 months, and then it's a overconfidence bias. Now they think they've got the secret sauce until things turn around.
More and more people, Alan, because I'm out there just about 2-3 nights a week, doing education classes to the public, right? And I would say over the last 6-8 months, I've never seen so much more overconfidence in the U.S. markets.
Right.
In my almost 20 years of doing financial planning.
Yes, and that's because we've had a tremendous bull run, and so whatever you invested in the U.S. market did well, and so then you start thinking you're a great investor, when actually you just kind of rode the tide.
And and you got to be careful too, because the downsides happen quickly, right?
They do.
And it's like when we least expect it, because if we knew it was coming, we would have gotten out.
Right.
Right? So it happens when at least, but to get the money back, it's a harder road up than it is down.
True.
Because if you do the math, if you lose 50% of your money, you don't need a 50% rate of return to get your money back. You need a 100% rate of return to get your money back.
Yeah. So if you bought a stock for $1,000, it went down 50%, so now it's worth $500. If it goes up 50%, well, 50% of $500 is $250. So you only got $750. You don't have your $1,000 back yet.
Right. You need a full 100% rate of return. So the market could drop 50, but for you to get back up, it takes you twice as much to get it back up.
As a percentage.
As a percentage.
Mm-hmm.
So if you don't have a strategy in your overall portfolio of looking at things to say, hey, I need some downside protection in regards to, treasury bonds, government bonds, short-term tips, or whatever, because it's like, well, why do I want to buy something safe? I look at the markets. The markets are going to continue to roar, and I've already missed out, and I need to catch up. I haven't saved enough. I mean, all of this leads to disaster. Absolute disaster. So you want to understand the risk that you're taking on the portfolio, making sure that it's appropriate given what your goals are. I mean, if you want a super high octane portfolio, you want the highest expected return possible, right? So just here's what you do. You have one asset class. It's called small value in emerging markets. Okay?
That's true.
That will give you the highest expected return. So if you want really high octane returns over the long term, that asset class will probably outperform any other asset class by a long shot.
Yeah, and that's the key word, is over the long term, because in any one year it could lose 50% or 80%.
Yes.
But then it goes up 160%. It's a wild asset class, but it is amazing when you look at 10 years or 20 years history, it's very often at the highest rate of return of all asset classes. And it's because it is so volatile and it is so risky. So investors, the only way they invest, they expect a high rate of return, and they generally receive it
You need to
over
get
time.
Compensated for that risk, Alan. That's what people don't necessarily get, I think, is that, all right, well, if you got a small startup company that you've never heard of, right? But it's not that. It's a little bit larger than a mom and pop shop that is traded on an exchange. But still, all these small companies, no one's ever heard of any of these companies, right?
Sure.
And then you have the big company like Facebook, right, or ExxonMobil.
Right.
Okay. Well, if they had the same expected rate of return, no one would ever invest in these small companies.
Yeah, you'd always go with the stronger one.
Why
right?
wouldn't you? If the stronger company gives me a better return, why would I just put all my money there?
Right.
Because the small company, I don't know, never heard of them. They don't have a track record. They'll probably blow up next year. Why would I invest? Well, you're going to receive a higher expected return. That's why you invest, because when you invest in smaller companies, you probably have a little bit more ownership in the overall company. Cost of capital equals expected return. Merton Miller, right there, Nobel Prize winning economist.
Well, look at you.
Yeah. So, but you have to think there is no free lunch at all. And so you just have to kind of put things in a perspective. If someone could get 3% every single month, God bless you. I'm not saying it's impossible. I think it's highly improbable.
Right.
And how we want you to look at your investments is to make sure that you have the highest probability of success for your financial goals.
Good way to say it.
Let's talk about this one. I am a 24-year-old college student working full-time, roughly $24,000 in salary, and have a Roth IRA in addition to an inherited IRA.
Okay.
With the inherited IRA, I have to take a distribution to cover my entire life.
True.
Okay. In the Roth IRA, I am contributing monthly and have roughly $8,000 in there so far.
Well, good for you.
My inherited IRA is $18,000.
Okay.
My intent is to take a distribution and put them back into the Roth IRA after paying the taxes. When discussing with my father how much I should withdraw annually, his advice was to take the minimum each year to put out the tax bill. To me, it makes more sense to take as much as I can up to $5,500 contribution limit without going up a tax bracket. This way, I have it all moved out and I can grow it in a Roth IRA before I reach the point where my income has increased and I face a higher percentage tax rate. Which one of these strategies would you recommend? Or is there a different strategy to manage the IRA that you would suggest? I'm aggressively investing in both accounts due to my very extended timeline for retirement and have a separate brokerage account that I can withdraw from if I need the money in the short term. Now, this kid is sharp.
This is a great question, if I do say so myself. So 24 years of age, making $24,000 a year. First of all, even if you don't itemize between standard deduction and exemption, it's about $10,000. So let's just say taxable income is $14,000. The 10% bracket goes to, for a single person, about $18,000. So at an absolute minimum, you ought to be pulling $4,000 per year out of this inherited IRA, because that's only 10% federal tax and probably almost nothing if it's California. I don't know if it's California or not. That would be a no-brainer. You also, even anything above that is taxed at 15%. That's a super low rate. So you could even withdraw the whole thing and only pay 15% tax, or maybe you straddle a couple of years, do 9 1 year, 9, whatever. But the sooner you get it out, right, then it's going to stop growing in a retirement account. Now, you can only put $5,500 into Roth per year, but make sure that you maximize that. And man, 24 years old, already got $8,000 in a Roth, adding $5,500 per year. That's some good stuff, because that Roth IRA in retirement will be 100% tax-free.
So I got 3 comments on this. Some of you might be thinking, okay, well, if there's an inherited IRA, he's got to take the distribution over his life expectancy. On $18,000 at 24 years old, that distribution is probably a few $100.
It's not very much, right?
So he's got to take the distribution. You cannot convert an inherited IRA to a Roth IRA. Right? So if that distribution, he cannot convert it.
No, he can't.
However, he's making a contribution, which is a little bit different. The IRS doesn't necessarily track where that money is coming from as long as you have earned income.
True.
So if he's making $24,000, he has earned income. And maybe that $24,000 that he's earning, he's spending every last dime of it. But he's got this inherited IRA that he's taking distributions. He's taking more. Well, his father said, no, just take the minimum distribution, right? And let that continue to compound tax deferred. Why would you want to pay the taxes before? Again, that's where the father's messed up. And that's where most clients are still screwed up, in a sense of like, all right, defer, right? I don't want to pay the tax now. I want to kick the can down the road. Well, don't do that in this scenario. As Big Al just said, your tax bracket is almost zero. Take as much money out of there as possible. I like him just taking out $5,500. Then it goes directly into the Roth IRA, right? So it takes out of the inherited IRA. Again, you cannot convert a distribution from an inherited IRA. If he did not have earned income, he would not be able to do that strategy. You cannot take the distribution from an inherited IRA and make a contribution to a Roth IRA if you don't have earned income.
True.
Since he has earned income, he can do this. So he's taking the distribution. I would suggest take the $5,500 out, pay a minimal tax on that. He'd be in the 10%
Mostly.
on most of it, and another $1,000 in the 15. So your tax bill is a couple $1,000. I'm not even that, a couple $100.
Right. So on the other hand, Joe, I'm thinking at this, he's already got $8,000 in a Roth at age 24. So he's got a source to do that, right? Or maybe it's even from his current income. So maybe, like, let's just say he's already putting $4,000 in, so he can only put in another $1,500. I would still take out at least $4,000 out of the inherited IRA because he's in such a low bracket, right? And then you've got that money that you can then keep contributing to the Roth IRA as you qualify.
But here's where I'm coming into real life, and you are the CPA number guy.
Okay.
He pulls out more. What's he potentially could do with the money?
He could spend it.
Yes, and I don't want him to spend it.
I don't think he's going to. He's disciplined. How many 24-year-olds do you know that have $8,000 in a Roth?
I don't know.
None.
My future wife. But no, because, right, you're 24. You know, when I was 24, if I had an extra, right, I maxed out my Roth IRA. Got a couple $1,000, fellas. Key West. Let's do this.
Yeah, but that's you. He's more disciplined.
Yes, he's a lot more disciplined.
Or she.
Or she. So, congratulations. That's the question of the month.
Yeah, that's a good one.
That's
I like
a great
that one.
question. You know, it's a smart kid. Don't listen to your father on this one. Don't listen to Big Al. Listen to me. Because, right, just take on enough. Let the rest continue to defer. Just do enough to put your Roth, get all that $18,000 out, a very low tax bracket. But if you know you're going to get a big fat raise in it, then I would listen to Big Al. All right, guys, that's it for us today. Hopefully you enjoyed the show. Check us out on iTunes, and we'll be back again next week.
So to recap today's show, whether taking Social Security early is a good idea or not depends entirely on your situation. People like the idea of raising taxes on the wealthy. Filing a tax return and paying your taxes on time are always good ideas. There's still time to contribute to your IRA for 2016, and a distance of 3 feet just might make a difference when you find money. How you decide is up to you. Subscribe to the podcast at yourmoneyyourwealth.com through your favorite podcatcher or on iTunes, where you can also check out our ratings and reviews. And remember, this show is about you. If there's something you'd like to hear on Your Money, Your Wealth, just email info@purefinancial.com. Listen next week for more Your Money, Your Wealth presented by Pure Financial Advisors. For your free financial assessment, visit purefinancial.com. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision. Your Money, Your Wealth opening song Motown Gold by Carl James Pestka is licensed under a Creative Commons license.